Earnings dropped 74%. Hey, what's going on, everyone? I'm AJ. This channel is about personal finance. Schools don't teach it, so I will. This video is all about the bank earnings for Q1 2020. Yes, the earnings season has kicked off. Banks are leading off, and, well, it's kind of a crazy situation going on with Roni, that pandemic thing. So let's see how these companies did this earnings season. Obviously, the pandemic is on everyone's minds. So, how did the banks do? And what does the future look like? Because honestly, Q2 looks a lot worse than Q1, but we're talking about Q1 in this video. We'll get to Q2 when we get there. In this unprecedented time, we look to the banks to kind of forecast what they expect the future to look like in terms of the economy and people's financial abilities. Specifically, we want to look at how the banks expect borrowers paying their loans. Essentially, banks will set aside money when they expect people to not be able to repay their loans. And let's just say they put aside a lot of money this quarter, so things may be looking grim. So anytime I talk about loan loss reserves or setting aside cash or money for like loan provisions or something like that, that's what I'm talking about. Basically preparing for people to not be paying their loans. Last time I did a video on earnings, it was very unfortunate because the file got corrupted, and I believe that was because I was doing 15 stocks in one video. So that's why this time I'm going industry by industry and doing about like 5 stocks at a time. So we'll see how that works and if that goes well. Let's go take a look at our 5 bank stocks. Before we do get into that, I just want to put out a disclaimer. This is coming from my point of view. So some information that I find essential for you, you may not even care about at all. And that's okay. I'm just obviously giving my opinion in my video. This is not at all a research report, and you should not make an investment solely on the information found in this video. Make sure you always do your own research for investing. If you do want to follow along with some of the things I'm looking at, EarningsCast is a website where you can listen to all the earnings calls. Basically listening to what the CEO, what kind of tone they have, and all the other people on the management team, listening to how they answer the questions. That may be something that interests you before you get into investing in a certain company. So with that being said, our first company is JPMorgan, aka Chase Bank. Revenue was down 3% and earnings was actually down 69%. I paused there because 69%, that's huge. But as you'll see with these other banks, it actually isn't that much. In any other situation, that would be like, what is going on with this business? Are they losing all their customers? Are they going out of business? Like, what's going on here? But in this situation right now, that seems to be fine. So 3/4 of their branches remain open. 70% of their workforce, however, is working remotely. Many banks are helping out their customers by extending deadlines for payments on loans, and JPMorgan is obviously no exception to that. The main advantage here that I got from the earnings report of JPMorgan is that they have the highest credit rating for their borrowers. So that means that their borrowers are the most likely to repay those loans because they have higher credit scores overall. And they actually ramped up those requirements even more. Next company we're going to be talking about is Bank of America. Their earnings were down 45%, and Bank of America's revenues were actually down less than 1%. An interesting note about Bank of America is that they said they will not fire or lay off anyone in 2020, and they will also continue with their internship summer programs for their younger up-and-coming workers. Now, their trading revenue was up huge at 22%. That basically comes from their wealth management portion of their business, where they have traders going in there and making some profits. That is due to high volume that allowed them to make huge gains in the market. For comparison, JPMorgan had trading revenues up 32%, so even more. The most positive thing in terms of company results for Bank of America is that they had 9% more investment banking transactions in a quarter that was not very good for investment banking, meaning they gained market share. Our next company, it is Goldman Sachs. For Goldman Sachs, their profits were down 46%, while revenues were basically flat year over year. 98% of their employees are actually working remotely, so that's quite a lot. So as I mentioned in the previous one, Bank of America, we talked about trading volumes. They're actually 2 to 3 times what we would normally see in this quarter. And also the crazy thing about Goldman Sachs is that 3 of their 4 business segments actually saw growth of 20+%. So that's kind of crazy. That means they are kind of relying on that one that didn't do that. So it obviously had a bad quarter in that segment. But the other 3 produced 20+ growth, so that's great. That one that they rely on the most is asset management, and obviously stocks tumbled in March, so that's what we see from that. And just for comparison with JPMorgan and Bank of America, the trading revenues were actually increased by 28% for Goldman Sachs. Now that's not as much as JPMorgan, however, it's a much larger portion of the business given that Goldman Sachs is a top 2 investment bank in the world. And the main positive takeaway for Goldman Sachs is that they were the one bank to actually beat what was estimated for revenues. So before we get into the final 2 stocks for the video, I just want to say that there will be a blog post linked in the description which has anything I didn't cover, like if I edited something out or if I just glossed over something, I may have put it in the blog post. And if so far you are enjoying this, I would appreciate it if you hit the like button. That lets me know that you like this specific type of video. And sharing helps a ton as well, especially if you have someone you know that likes investing and they want some more news and analysis and stuff like that. This would be a great video for you to share with them. And also, if you have someone who's completely new and they just want to get enveloped in the world of investing, that would be great if you could actually just pause the video and share before you forget. So I'll do a little motion here for you to pause and then you come back later, okay? Are you back yet? Okay. And one last thing before we get into the last 2 companies. The last 2 are not Citi and they're not Wells Fargo. The reason being, even though they are part of the big 4 banks, I just don't have any investment interest in those companies right now. So I didn't include them in this video. So for our 4th stock, we have Ally Bank. I chose to do this one because it's an up-and-coming bank, specifically in the online space. So they actually lost money this quarter, and it was about 155% down, which seems like a lot, and it is a lot. But, that's just the situation we're in. We had revenues down 12%. So the biggest drop we've seen so far in this video. Obviously, a smaller bank is going to be hit harder. So a trouble point for Ally is that they're a top 2 auto loan originator and lender, and they're also getting about 25% of those borrowers deferring their payments, which is not a good sign. If we look at the big picture of the bank, we have their insurance underwritings, which had the biggest growth in Q1 of all time. And they've also seen a lot of growth in their online banking in terms of deposits and also their investing platform. So for the last stock of the video, we have Synchrony Financial. And you can almost section off the first 3 in one category and the last 2 in a different category, just because we have the first 3 really big banks, and then these last 2 are a much smaller scale, so it may be better to compare the numbers between these 2 in terms of Ally and Synchrony. Synchrony nearly doubled their loan loss provisions from last year, resulting in a 74% downturn in profits, and they had an 8% decrease year over year in revenues. A major hit that happened to this company back in 2018 is they lost out on their partnership with Walmart in terms of supplying their credit cards to Capital One. So that's a big hit. However, their co-branded cards did grow 8% in year over year. One of the things I actually knew this bank for was supplying those Walmart credit cards, just because that's a big deal. Walmart's one of the top retailers, of course. Another downside for these smaller banks in general, but also specifically looking at the report for Synchrony, is that they tend to have lower FICO scores for their borrowers. They also didn't give as specific of information as Ally did, which means they're probably hiding something unless they just don't have the data. But Ally said their average score was about 686, and I'm not projecting that. I think Synchrony has a lower average, but they just gave less specific numbers, saying that 45% have above 721, 73% are over 660, and that's all the data they gave. We just don't have the exact numbers. So all I know is that I can most likely assume that the bigger banks have higher credit scores for their borrowers compared to these smaller ones. Also, when I say smaller banks, it's kind of relative because these aren't small banks. Like, these are nationwide banks, if not worldwide, but like smaller compared to the big four like Citi, Wells Fargo, JPMorgan, and Bank of America, and even Goldman Sachs, which I included in this video as well. Overall, there's more risk when it comes to a bank like Ally and Synchrony. You like to see JPMorgan with the high credit scores, of course, and loan requirements for their borrowers. But overall, I don't think any of these companies are going out of business. I just think they may take a hit, and they're basically projecting that they will take a major hit, and I think they'll have enough cash to cover all those costs and not have any trouble getting through this recession. Thank you very much for watching. I hope you did get something out of it. I really liked going over these stocks, specifically banks. If you did like this video, then, well, of course, you want to hit the thumbs up thing. I call it the like button. And also subscribe if you want to see more content from me, whether that's videos like this or any other financial content, which includes real estate, credit, budgeting, all that. Before you leave, I have a few questions that I would like to hear your answers to in the comment section. So number one, which bank stock do you like most right now? And that doesn't have to be something covered in this video. That could be like Citi and Wells Fargo, like I mentioned, or any other bank stock you know. Second, do you want me to go over bank stocks again next quarter for Q2? And if so, please recommend which stocks you would like me to include in the video. If you like, let's say, for example, you like Goldman Sachs and you want me to include it again next time, then feel free to leave a comment. And if there's something that I left out, please go ahead, suggest the stock, and I may just put it in the next video. And the final question I have for you is, what other industries or sectors do you want me to go over? I do plan on going over healthcare as my next video, but is there anything else like travel, tech, any other category that you think would be good for this type of video? And of course, going along with that, are there any stocks you'd like me to include or go over? All right, so that's about it. That's all I got for you today. Healthcare is coming soon. Make sure you do check the description for any links that I have and referrals and stuff like that. Disclaimers in the description as well. The blog, of course, is down there for more information. And, please comment, subscribe, like, and I'll see you guys next time. Peace.